Hi everybody, welcome to this webinar brought to you by Bursa Malaysia, and it is titled Risk and Portfolio Management in the Volatile Market. Now, especially now, I think we have extreme volatility with a lot of things happening right now, rising COVID cases. I think it's better that we remain cautious in the outlook. So today, our speaker will share a view about the market outlook briefly and how we can do risk and portfolio management in this volatile market. All right, so today this session also received overwhelming response, so we got so many of you registering for this webinar. So if you can hear us today, please let us know where you're tuning in from. All right, cool, thank you so much. Excellent. We have KL, Penang, Kota Komunis Sarawak, Sabah, Terengganu. Wow, okay. Klang, thank you so much. So that means my audio, video, and slide also works fine. So thank you for our friends here tuning in from all over Malaysia. All right, so today we are going to have an exciting sessions. Now, before we begin, just let me talk about disclaimer. So whatever we share on this webinar is only for educational purpose. In no way that we give any buy or sell signal for any companies that that we cover. So in the event that you want to buy or sell anything, you do it at your own risk. Okay. All right. So tonight we are going to have a very accomplished speaker to come online and share with us. He is none other than PC Wong. He is a full-time investor, author, and a trainer. He has more than 20 years of investment experience in Bursa and 11 years of investment experience in the foreign markets, such as Hong Kong Stock Exchange, HKEX, Nasdaq, New York Stock Exchange, ASX, and even LSE. He is a best-selling author of Invest in Foreign Shares and Invest in REITs. His area of expertise includes financial analysis in broad sectors in resource industry and REITs. He has more than 7 years of experience teaching retail investors in the local stocks as well as in global stocks. Academic-wise, he graduated from National University of Singapore in 1989. Okay, so just a bit more add-on information. I know PC for many years, and he actually is a very well-read person in the market. And every day he spent about 8 hours, okay, listening to podcasts, reading charts, economic data, the trends, and so on. So today he's going to share with you briefly about the outlook and also how you can do risk and portfolio management in this period of time. So without further ado, let me hand it over to you, PC.
Thank you very much, Shane.
Right.
And a very warm welcome to those who are tuning in. So our agenda today is understanding the current market risk, learn how can this risk affect a volatile market, learn risk management strategies to minimize the loss and to hedge accordingly, learn how to reconstruct your portfolio in a volatile market, and learn to find investable industries in turbulent times. Now, let's look at the current market risk. There are three kinds of risk currently. The economic, which refers to the output, productivity, employment, etc., driven by the economic indicators. Financial, now this refers to central banks, interest rate policies, debt outstanding, and others. Geopolitical, this refers to regional tension, including threat of military conflicts and subversion of governments. Then this risk could be on a national scale, such as economic and financial in Malaysia context, or global risk, which covers all three. Now let's look at Malaysia on an economic risk basis. Currently we have slow growth owing to ongoing COVID-19 environment. Malaysia GDP, as per Department of Statistics Malaysia, shows that our GDP after Q1 has declined to negative 17.1% in Q2. And according to Bank Negara, by the end of the year, Malaysia would likely register negative growth from negative 3.5% to negative 5.5%. Now, because most of the expectation were that we will have a V-shaped recovery, but in the past 1 month or so, we are having a sudden rise in our national COVID-19 cases, and this has really impeded on the further recovery of the economy. Now, if we look at it, the trend will be mired in the low range for longer due to inconsistencies in tackling the spread of the virus globally. Okay, this will cause a general slowdown in travel and will deeply impact Malaysia's tourism industry. Locally, consumer spending will be negatively impacted due to fear and uncertainties, leading to less spending and more saving. So although Malaysia's rise in the COVID-19 cases is not as it's not as high, as those in the US, Brazil, or India, but because generally it impedes the entire global travel and tourism industry. And Malaysia also relies a lot on income being generated from establishment in the retail, hospitality, as well as in the travel industry. So with the tourism industry being hit very hard, it has spilled over across broad sectors, because not only will the hospitality, retail, and travel industry be impacted, because there's a lot of other industry that supplies to the hospitality and travel industry. Okay, for example, those that sells food, beverage, okay, and other manufacturing goods and services. So in the service sector wise, especially those in the hospitality and travel industry, I consider them in the hotel, F&B, tourism, and transport, will continue to fare poorly. Export from the oil and gas sector will be affected by poor demand and pricing. Now, Malaysia prides itself as a major oil exporter, okay, and over the past 1 or 2 years, oil has been in the very, very low range, okay, and this looks set to continue, and therefore Malaysia's income derived from the oil and gas industry will continue to be impacted. And if we look at economic growth by sectors, now this is comparing Q2 and Q1, okay, in terms of services, it is down 16.2% versus Q1, where there was a growth of 3.1%. And in manufacturing, okay, it is down 13.3% versus 1.5% in Q1. Construction-wise, it's negative 44.5% versus negative 7.9% in Q1. And in the mining and quarrying, it is down 20% versus down 2% in Q1. Then in the agriculture, there's a slight uptick of 1% versus a negative growth of 8.7%. Now, if we look at it, all this, okay, on the GDP scale, okay, services comes from the manufacturing, and services comes from the consumption. Okay, if let's say consumption is low, it will impact manufacturing and also consumption of services. Okay, then in terms of if economic uncertainties is there, a lot of people would actually avoid from buying high-end items like properties and such, and therefore construction is also impacted. Okay. Now, in terms of how risks and uncertainties impact consumer spending and investment, we can look at the private and final consumption expenditure is down negative 18.5% versus a growth of 6.7% in Q1. Okay, then you have gross fixed capital formation. Okay, this is actually investment into, let's say, real estate, in terms of inventories by the manufacturers, because it's also a form of investment. Okay, it's down by 28.9%, and government final consumption expenditure down versus Q1, just growing by 2.3% versus 5%. Then in terms of export, it's down 21.7% versus -7.1%, and imports down 19.7% versus -2.5% in Q1. So Malaysia is not the is also imports a lot of goods from overseas. So if let's say consumption is down, it will also affect the import. Okay, and normally people would think that, oh, if import is down, then most likely with our export we will have a surplus. Not necessarily so. Okay, because export can be down in a, you can see here that export is down greater. Okay, because first of all, you know, I would think that Malaysia export a lot of products overseas, and because global demand is poor, therefore it also affects the export. Now, falling consumer spending and investment will lead to a weaker GDP growth. So weak GDP growth often lead to higher unemployment. Now, unemployment in Malaysia remained fixed at 4.7% in August and July. Much depends on the trajectory of the economy in the coming months. But looking at it, it doesn't look pretty good right now, because we are again back to CMCO, and to a certain extent, it will affect quite a lot of businesses, especially in the F&B business, which have certain restrictions. Yeah, unemployment and fall in private investment could lead to falling productivity. Now, this diagram here shows how productivity plays a role in the economy. Now, normally, if you have a very good workforce, okay, you have investment into plant and equipment, into R&D, investment into people, okay, often it will lead to increase in employment, because all this investment in fixed asset, in R&D would demand the company to recruit people, and therefore it helps to increase employment. Now, when increased employment, it will create increased consumption. So increased consumption leads to higher GDP. Okay, and then it goes back to, as the economy continue to grow, then more people would actually benefit, and companies will see the potential that the economy will continue to grow. They will continue to invest in plant, R&D, and people. Now, all this investment often lead to increase in productivity. So when you have increase in productivity, okay, it will also help to increase the output. Okay, on top of that, increase in productivity also help to reduce cost per unit, okay, leading to increased consumption. So that is why productivity is the center of how a GDP continue to evolve on a growth trajectory. But if let's say we have low employment, okay, and because of uncertainties, companies withhold from investing in plant and equipment, in expansion, okay, in fixed assets, then productivity suffers. And as a result, okay, if increase in productivity leads to higher GDP, then a decrease in productivity would lead to a decrease in GDP. So financial risk. Now, due to the slowing GDP growth, the pressure increasingly falls on the government to act via a stimulus package. To do so, the government has to incur higher debt, and just recently we have increased debt as a percentage of GDP by another 5%. Now, higher debt in a weak GDP environment could impact Malaysia's international credit rating. A negative outlook could increase the cost of borrowing by the government. So this is how the whole thing is interconnected. Okay. Increase in debt and potential negative outlook on credit rating could weaken the Malaysian ringgit. While a weaker ringgit can spur exports, it can also hurt local consumption due to inflation. So should Bank Negara adjust interest rate lower, ringgit could also weaken versus other currencies. So what we are seeing right now is that it's actually quite a dilemma, because if government wants to spur consumption, okay, they have to ease the policy. But easing the policy, sometimes if let's say measure against the GDP, the debt starts to increase, then foreign rating agency would actually rate Malaysia as having a negative outlook on Malaysia's debt, and that would increase the cost of borrowing. So when the ringgit becomes cheaper, yes, it can spur export, but similarly, it can also result in the higher inflation. Okay, so this is how all these are interconnected in a vicious cycle. So IMF forecasts in terms of global economic risk here, IMF forecasts global economic growth at negative 4.9%, while the OECD forecasts growth to fall to negative 4.5% in 2020. Now, these estimates are based on major economies recovering strongly in Q3 and Q4, but even these are based on the best outcomes. Okay, now why do I say so? When IMF made the forecast a few months ago, they never considered that the sudden spike in COVID-19 cases globally, and right now Europe is undergoing another lockdown. Okay, whereas US continue to see cases increasing by over 100,000 per day. Okay, and this would actually put fear in a lot of people, and people would then, prevent themselves from spending and start saving. Okay, when uncertainties are there, people tend to save rather than to spend, and that would actually snowball in a lot of developed economies because they have a high percentage of reliance on the consumer to spend to generate growth in the economy. Yeah, so as I mentioned, there's a resurgence in wave 2 of the pandemic across the US and Europe, which could hamper the recovery process. In Latin America and India, the pandemic has continued to spread across countries with little signs of letting up. Now, research data such as PMI indices seem to suggest that there is an increase in economic activities driven primarily by trillions of dollars in stimulus. So on one hand, everyone expects, the major central banks of the world to keep on, pumping liquidity into the market, okay, through various stimulus programs. But it makes the economy very reliant on stimulus, that people forget to look at, companies and individuals, no longer rely on their own ingenuity or to look at creative ways, okay, which to stimulate growth in the companies, but rather rely on government handouts. So what happens is, if the stimulus dries up, so will economic activities, just as what we are facing right now. Okay, because when the consumer has become so reliant on government handouts, they suddenly, feel like, if, for example, what happened in the US, they have this $600 per week of unemployment claim as a stimulus. So then the US consumption starts to go up, but as soon as it dries up, consumption falls drastically down. Okay, because if they are getting paid $600 per week, who wants to work? Because apparently 2,400 is better than the better than the pay that they get while they were working. Okay, so that's why, when people do not want to work, then productivity suffers. Yeah, so that's why I think, when it comes to the PMI, often PMI is based on sentiment of the purchasing managers, okay, through a survey. So it is not actually a foregone conclusion that because the PMI has a high reading, therefore economic activities would also have a similarly high economic activities as well, because the survey is done, and during that time, if the purchasing managers feel good about the economy, then the index will actually rise. But subsequently, if, let's say, consumption starts to drag, then economic activities would actually fall. So what many economists fail to see is that the economic malaise is due to debt saturation and not COVID-19. Now, COVID-19 is merely a catalyst. So a lot of people would say that economy is down globally because of COVID. It's not. Okay, even before COVID, in September last year, we have the repo madness. Suddenly, there's a shortage of liquidity in the global financial system, and the Fed has to print trillions of dollars, okay, to offer its own offers liquidity to the market. Okay, they so much so that the Fed eventually have to go on extended period of time to keep on pumping liquidity into the market. Now, this goes to show that the repo madness that happened in September 19 before COVID is already indicative that there is some structural weakness in the global financial system. Okay, and even before COVID-19, European economies are actually facing negative growth in their GDP. So COVID-19 is merely a catalyst that bring forward all the potential problems into the current period. If let's say there's no COVID-19, I think within 1 year or 2 years, we will see further weakness in the global financial system that still would require central banks to pump liquidity into the market. It's just that COVID-19 bring it forward much earlier. So according to the IIF, Institute of International Finance, in its publication in July 2020, global debt to GDP ratio reached a record of 331% or 258 trillion in Q1 2020. I think by now it is easily close to 270 trillion. So the first signs of a financial crisis erupted in September 2019 in the repo market. COVID-19 just made it worse. Now, since then, central banks have embarked on extensive QE, with Fitch estimating in June 2020 that developed nations will spend 7.6 trillion in QE, while emerging markets will spend 1.2 trillion. Yeah. However, in my belief, you can't solve a debt problem with debt owing to the issue of debt saturation. At some point, more debt will not create more growth. And this is very true, because if that can solve the problem, then with the Federal Reserve, pumping almost 4 trillion, almost 3 trillion into the economy after the financial crisis, by right, the economy should be very, very strong. But it can't, because in the market sell-off in December 2018, in the last quarter of 2018, the Fed have to say it will stop raising interest rate, then it will stop its quantity tightening. Otherwise, the market will collapse. So that means that when central banks keep on pumping money into the market, there is no way they can reduce their balance sheet, or the government would at some point in time would not be able to pay off the debt. And to keep the debt sustained, the central banks have to keep pumping money into it. And therefore, what we see is continued weakening of major currencies. So this is just to show you. Now, this is the Federal Reserve balance sheet. This was during QT, or quantity tightening. Okay, the Fed reduced its balance sheet, but then suddenly there was the crash in 2018. Then the Fed start to stop raising interest rate, and then what we have is the repo, the more liquidity injection, buying back the debts, and then we have COVID-19, and then it spiked up. Okay, this is the ECB. So you can see that the debt would just the central bank's balance sheet would just continue to grow. Why does central bank's balance sheet grow? Because when government is too overburdened with debt, okay, there will be, people do not want to buy the bonds, because they would want to have higher interest, because there's risk. So what happened is that the central bank say, okay, no worries, okay, we will keep the interest rate low, but then we will buy the bonds. So they keep on buying back all the bonds, and that's why the central bank's balance sheet keep on increasing, and therefore maintaining interest rate very, very low. Okay, for the ECB, they have been in negative interest rate since 2016. Okay, and this is the Bank of Japan. Okay, you can see the Japanese central bank balance sheet keeps on increasing, so much so, okay, that is close to about 250% of Japan's GDP. So Japan can never pay off its debt, and that's why they continue to maintain negative interest rate, I think, for quite a number of years. In fact, if you look at the Japanese economy, ever since it burst in 1989, it has been in a deflationary cycle for, I think, coming to 3 decades already. Now, this is the Swiss National Bank balance sheet also keep on increasing. Then you have the Reserve Bank of Australia. Okay, this is due to COVID spike. And then the Canada is even worse. Okay, they were doing pretty okay because of COVID. Then, you know, the balance sheet suddenly shot up. This is the Bank of China, and this is the Bank of India. So all these charts goes to show that once central banks embark on QE or easing, they can never turn back the clock. Okay, because if they do so, then they have to unwind their balance sheet. And once central banks start selling bonds, government bonds or corporate bonds that they have bought, the yield would suddenly shoot up. So when the yields shoot up, the cost of borrowing becomes expensive for the governments and corporations. So for example, in the US, the total US government debt is 27 trillion. Okay. Therefore, you know, the US Federal Reserve will never be able to raise interest rate ever again. No matter what the Fed say that they can look at raising interest rate in 2020, it will never happen. Because if it can happen, it would have already happened in 2018, and the Fed wouldn't care even if the market crash, they will continue to raise interest rate. But no, when the market crash, the central banks now are coming in to plug the fall in the market. So that is why the Fed will never return to normalcy in interest rate. Assuming it goes back to 5% with 27 trillion debt, it means just to service the interest of the debt is 1 trillion a year. Okay, so that is why US debt will continue to mount, and the European countries' debt will continue to mount. A lot of countries' debt will continue to mount, and more debt will not actually create economic growth. For example, the US debt actually grow much more exponentially over the past few decades versus the GDP. So when debt growth exceeds the GDP, it means that the government will no longer be able to service will never be able to pay off the debt, but they can continue to service the debt by continue to issue more debt. Okay, so the charts show that once QE is unleashed, there's no going back to normalcy or raise interest rate, as governments could default on their debt. Global currencies are expected to devalue over time, sparking inflation. Inflation is, if severe enough, could cause stagflation, where we have slowing growth but high inflation. Now, in the coming quarters, expect many central banks to implement MMT, which is modern monetary theory, and UBI, universal basic income. Now, this would push the money printing into an insane level, because already as it is, central banks now are looking at putting money directly into consumer hands. Now, because of all the, if you look at it in Europe and in US, there's a lot of people having demonstration, protests, and riots, because the poor people are being priced out of the economy, and that is why the income gap between the rich 10% versus the other 90% has actually widened very, very huge. Okay, so what the central banks would do now, they are looking at printing money and giving it directly to the consumer. Okay, so as to spur consumption. Okay, but as I mentioned again, when you put money into consumers' hand, less would actually want to work, because without working you get income. Okay, and that would actually affect the productivity, which will then affect the GDP. So geopolitical risk, when we look at it on a global basis, okay, there is no short of global tension worldwide. Okay, in the US, riots and violence will likely ensue no matter who wins. Okay, whether eventually Joe Biden is declared, not by the media, yeah, declared by the electoral college that he has won, then he's the president, there will still be riots and demonstration. Okay, because the US political divide has become very polarized. Now, even if Biden win, I would think that the US will still intensify trade war, tech war, and cyber war against China, because this is what we call the Thucydides trap. Okay, where one winning global power will never want to cede its power to a second rising power. Okay, potential military conflict in Mediterranean Sea, South China Sea, Middle East, and Venezuela. A military conflict will push up the price of commodities, especially oil, base metal, and precious metals. However, global economy will slump. Now, ex-Soviet countries will see rising tension with NATO, especially if, let's say, Biden is really the president, then he would ramp up his anti-Russia rhetoric. Okay, he may scale back down against China, but he will actually ramp up against Russia. Okay, because this is the behavior of the unfortunately for the US, okay, it is an industry that is driven by the military industrial complex, because that's the only productive manufacturing base that they have. Okay, now how risk affect volatility? Now, a confluence of events have resulted in three major risks: economical, financial, and geopolitics becoming prevalent at the same time. Markets become more hypersensitive to risk the higher they go. So although we can cheer that stimulus can actually push up the stock market, but the higher they go, the more sensitive investors would be to certain negative news. Okay, and because of that, there are risks. Now, risks create uncertainties. When uncertainties prevail in the market, investors will choose to wait on the sidelines. Okay, the lack of buying support will push the market lower. Now, risk could also divert funds from one sector to the other. Okay, for example, lately we see that because of the COVID-19, okay, those that in the hospitality, retail were doing badly, but people were moving into the clothes manufacturers as well as the pharmaceuticals. Now, risk could be damaging to an investment portfolio if they are ignored or misunderstood. So no matter how you plan your investment, you must understand what are the risks, okay, and have some preparation that in case a worst case scenario happen, what is your other plan? How could you actually minimize your loss? Okay, sometimes investors would like to plow all their money into one particular sector, and then suddenly when that sector performance start to deteriorate, resulting in a sell-off, then they also panically sell their shares. Okay, because they never make preparation for risk that would actually happen all of the sudden. So understanding risk also creates opportunities, especially to those who anticipate them and hedge against them. So how to manage risk? I see gold as a very important hedge against any type of risk. Okay, because gold has always been a means of wealth protection. Now, wealth protection comes first before wealth accumulation. Okay, now if you look at it, over the past 20 years, gold has actually increased, has actually gained 639%. Now, this was when gold was still hovering about 1,800 the week prior. Okay, right now it's already 1,900. So therefore, this could be in the region of around close to 700%. But if you look at it in the last 20 years, the KLCI index only gained 60%. Okay, so that goes to show that gold on the longer term would actually outperform quite a number of major indices. Okay, for example, in the US, gold actually have outperformed the Dow, have outperformed the S&P 500 over the last 20 years. Okay, but it has not. But the Nasdaq has marginally outperformed gold. Now, why is that? If we go back into history, in year 2000, there was the dot-com bubble burst. So what happened was the Federal Reserve start to ease, okay, in its policy, okay, low interest rate and all those. Okay, so what happened? People see it as a stimulus plow into the stock market, suddenly it becomes overheated, then the stock market crash. Okay, and then what the Fed do? They print more money, okay, leading to current situation, they are printing even more. So as value of currencies decrease because of the supply keep on increasing, then gold as value against any currencies would actually increase in price. And this goes to the same with ringgit. Okay, this is gold in ringgit terms. So let's look at the Trade Plus Sharia gold tracker. Okay, since inception, the ETF has gained 48% in 35 months. Now, if we look at it, that's easily double-digit growth, average out a year. And to me, that's not too bad, because in just 35 months, okay, it is aging closer to the KLCI index, which gained 60% over the 20 years. Okay, so look at the gold ETF as a form of a hedge and as a form of protection, because the way that the central banks globally are doing, especially the US dollar is in jeopardy of losing its reserve currency status. Of course, people would say, currently, everything is traded in US dollar and so forth. Okay, but I want to share a story with you that in Jackson Hole meeting last year, the bank governor of England at that time, Mark Carney, said the days of the US dollar as a reserve currency is numbered. Okay, and we see that right now, okay, that's a changing trend among central banks. Central banks especially are buying more gold than since 2008. So central banks are hedging already. Okay, so as central banks embark on MMT, UBI, QE Unlimited, currencies are destined to devalue versus gold. Now, it is also a good hedge against geopolitical tensions. Now, gold has reached record high in 73 global currencies in 2020. So that goes to show that whichever central banks, as long as they keep on easing, the government incur greater debt, putting more money supply into the market, it can only lead to a devaluation of the currency. Okay, and because gold is often seen as the cornerstone of stability, that is why central banks have been amassing gold ever since 2008, especially China and Russia. So that goes to show that, central banks themselves think that gold is the perfect hedge against further devaluation of their own currencies. So the other thing that you can consider is to look at commodities. Now, that is because global food shortage has arisen due to COVID-19. These are two headlines that I come across. This is by the South China Morning Post on the 2nd of April, and another one, the New York Times, on the 17th of September, okay, which has the headline, "The other way COVID will kill you is actually hunger." So why is that? Okay, because COVID-19 has caused disruption in the global supply chain in terms of food, because maybe you have come across reports that US farmers, because there's no distribution channel or less distribution channel, farmers are actually destroying their own produce in the farmlands because of the closure of a lot of restaurants, and farms that were initially supplying to restaurants suddenly find that they do not have that accessibility to other avenues besides restaurant, and then they have to destroy their crops as well. So that is why it creates a shortage of food. Now, from the headlines, it is abundantly clear that COVID-19 has disrupted global food supply chain, and global food production has also fallen. Weakening value of currencies is also pointing to an inflationary environment, as can be seen from the food price index. Now, this is if you look at it, 2020, after bottom, it has started to spike up. 2018, the food price index is lowering, okay? But 2020, you see, is moving up. Now, these are all the food sectors, and of particular interest, maybe you would like to look at vegetable oils. Okay, Malaysia actually, our vegetable oil is actually palm oil, and you can see that after reaching a bottom, okay, it's now moving up. A lot of the other sectors, except for meat, okay, meat is climbing down, okay, but in terms of dairy, okay, it's moving up. Vegetable oil is moving up. Sugar is also moving up. So that goes to show that inflation is already coming to the market because of too much currencies being printed globally. When you have too much currency chasing after very few goods, then you will have inflation. Now, inflation is not just an increase in the price of goods. Sometimes economists like to say that, okay, if price increase means that's inflation. But some economists argue that that is inflation when you look at the amount of M2 money in the market, okay? The amount of money in the market is an indication of inflation already. And it just so happens that it has not hit the consumers as yet. But we can see it, inflation as in the increase in the price of gold, the increase in the price of properties, increase in the price of the stock market. So these are inflationary indicators already, okay? So if we look at the Bloomberg Agriculture Index, okay, they have started to trend up. So roughly, we could have seen the bottom. And if we look at the trending FOA charts, okay, a number of agricultural products are actually seeing spike in price. So this could be the bottom. And over the next few months, we will know for certain. And actually, just a few days ago, I read that the soybean price have actually gone up. So which means if soybean goes up, then likelihood other vegetable oil would trend together. So I want to share with you that momentum strategist Michael Oliver and technical specialist Chris Vermeulen believe we are entering a global commodity super cycle. And this is based on their, especially Michael Oliver has based on his charts that runs for decades. Okay, so that is why the amount of money that's being printed chasing lower food production would actually boost commodity prices in the future. So commodity consumer staple companies offer an opportunity to hedge against rising inflation in food. So the other type, managing risk, some people would like to say, why not look at an invest ETF? So this is the Kananga KLCI Daily Invest ETF. So you can see that there's only one cycle here that a person can actually make money, and that was during the market sell-off globally. But ever since then, it has been very steady, no spikes and all those. So that's why, it is ideal for volatility trading. It's not something that you want to invest and hold long term. So not recommended unless you are an experienced trader, because you need to trade it, not a long-term investment. Because if you are holding, then you will keep on holding without, your capital is tied up, whereas other sectors, okay, has seen the share price moving up. Okay, so don't treat this as a hedge. Now, the other one is to establish a healthy cash position. Now, having a healthy cash position is important because it allows you to buy better stock when the market starts to recover. Okay, sometimes people would like to say, doesn't it doesn't concern me if it goes down. I just keep averaging down. Now, at some point in time, your bullets will run out because you do not know where the market bottom is. So rather than averaging down, okay, in a volatile market, you have the cash ready so that when the market has reached a bottom and it starts to trend up a bit, then that is when you can buy. No one can anticipate the bottom, but you can always buy near a bottom. Okay, that's why in a volatile market, I would say, avoid averaging down. It is like catching a falling knife. You do not know where the bottom is. Now, Warren Buffett's cash pile of 147 billion US dollar at the end of Q2 2020 and his investment in Barrick Gold and Sumitomo Corp is already forewarning the risk he sees. Now, why does Warren Buffett not investing in multiple of stocks? Because he sees the risk. Okay, and Warren Buffett likes to say that gold is a pet rock. You can only appreciate it, but it has no meaningful value. But he is investing in Barrick Gold, which means he sees a certain trend in the market that disturbs him. Okay, and his investment in Barrick Gold is not actually in physical gold, but actually in the value that Barrick Gold would deliver when the stock gains as the price of gold gains. And for your information, okay, Barrick Gold is a top 5 gold producer in the world, while Sumitomo is a major commodities producer and trader. So even that, Warren Buffett is already building his hedge. Okay, and these are the signs that already showing what are some of the more experienced investors are doing. Another person that is very much into commodities is actually Jim Rogers. So reconstructing the portfolio, what to avoid? Now, companies that rely on consumer discretionary spending, for example, travel, airlines, and hospitality, hospitality sector, and retail. As long as there's no meaningful and development or increase in the tourism market, these sectors will continue to be under pressure. Okay, and I think one of stay away from the airlines for the time being, because even as countries may gradually open up, it is still not globally opening up, and therefore even if there's air travel, it will be country by country. It's not immediately open internationally. Okay, therefore all these sectors will be laggard. And of course, also avoid heavy manufacturing. Heavy manufacturing are those that are in the high capital intensive manufacturing, which means things like in refinery, okay, in automobiles and such. So REITs, property and construction sector, this is also another sector I think you should avoid for the time being, because undoubtedly, okay, a lot of a lot of households are tightening their belt, and they are unlikely to incur additional debt because that is the concern over the job security. So also avoid financial institutions, because on 30th June, the S&P Global revises outlook on 5 Malaysian banks to negative. This is because of declining economy, and one of the things that you might not have realized is that Malaysia household debt per disposable income is one of the highest in the Asian region. Okay, because Malaysia household have too much debt, And if let's say interest rate remains very low, okay, and especially right now because of COVID-19, there's a lot of deferment of paying loans and all those, financial institutions are actually facing some risk, and therefore S&P Global actually revises outlook of 5 Malaysian banks to negative. So even as the financial institutions may look cheap given the valuation, but you need to look at, compare where you should put your money. Now hedging, I'm very in favor of. At least you have the gold ETF. Then you look at opportunity to enter into commodity and consumer staple companies. Now consumer staple means that those that are necessities, okay, not those that are into the fashion, okay, or high-end product, okay. No, those are discretionary, okay. But staple means that people need to consume it to continue to survive, and then have some hedging in terms of cash. Then there's also opportunities. For example, look for value in growth and utility companies. Now, utility companies will forever be in, they will continue operating. You cannot say that the utility company need to shut down, okay? And therefore, look for value. If the condition is right, the price have fallen somewhat, okay, then that gives you the opportunity to enter, okay, and opportunity to incur gain, okay. So I will consider, okay, growth companies as those in technology, medical supplies, and pharmaceuticals, okay, and in the utility section being the utilities and communications, okay. Communications is our part of our life. We cannot say that I want to stop using my mobile phone, okay, because of COVID-19 and all those. So look for, if the market has volatility, look for opportunity to enter at a position whereby you can anticipate gain from your investment. Now, reconstructing the portfolio, for me, this is just a suggestion, okay. It's entirely up to your own assessment, okay. I would put 30% in gold ETF. Now, if you understand that central banks will never be able to, major central banks, especially the US, will never be able to raise interest rate ever again, okay, regardless what the Fed say, okay, then with so much debt, the US debt to GDP will reach about 150% by next year, okay. If let's say measured similarly, at 150%, US will be in the same level as Greece and Italy when the whole government was near default in the European debt crisis. Now, on top of that, some of you might not know is that the US actually has Social Security and Medicaid. These are actually insurance for health when for Social Security is actually similar like the EPF, okay? And Medicaid is actually health insurance. As they grow older, they can actually claim when they see doctor and so on. But do you know that none of this has any funding, okay? It's zero. US Social Security has zero funding. And how US pay the Social Security? By borrowing money from the debt market to pay the people, to pay to the Social Security account. Now, if we take the total US debt, which is government, companies, household, and individuals, plus unfunded liabilities, plus Medicaid, total debt plus unfunded liabilities as a percentage of GDP, this might shock you, is close to 1,000%. So the US is actually a bankrupt economy, okay, because forever they will rely on that to pay off. So because of that, US dollar measured against gold, with US dollar weakening, gold would actually continue to climb. And not only that, other central banks are also printing money. So the more they print, okay, the more devaluation in the currencies. So that's why gold actually has reached record value versus 73 currencies globally. And that's why over the long term, gold will do very, very well. Now, Jim Rickards, some of you might know him. He has written a lot of books called Currency Wars and such. If he were to use a benchmark of the amount of M2 money in the market in 1980, when gold hit a record high of about $830 per ounce, and measured in today's money, M2 money in the US, benchmark against the 1980 high in gold, he worked out that gold should be close to about $50,000. Now, whether it's true or not, okay, is not is whether it's possible or not, it will happen. We don't know. But at the rate that the money printing is going, gold would actually outperform a lot of stocks and a lot of indices globally. So that's why you have to consider putting your money into the gold ETF, because assuming if your investment, okay, now with 30% in cash, okay, then you have, let's say, the other 40% being invested. Now, assuming the 40% of your investment drop by 50%, okay, let's say the total investment is, the total amount here is 100,000. If your 40,000 suddenly fall by 50%, then what your original investment value now is, from 40,000, it becomes 20,000. But let's say that gold being the hedge, okay, gold can increase by, let's say, 100%. Then your 30% now becomes 60%. So in some ways, although you drop 20,000 here, but here increased by 30,000. And therefore, you still achieve a net gain of 10% in a worst case scenario. So that is how you need to hedge your portfolio. It is not just saying that, I hedge my portfolio by having dividend stocks, okay, that pay me a good dividend, and then the rest I go into growth, okay, with little bit of cash. But you have nothing to hedge against something that fall everywhere, okay, even dividend paying stocks. Are you confident that in a market sell-off, the dividend stocks will continue to do very well? No, they will fall in tandem with each other. So if you do not have this, okay, let's say 30% in dividend stock, then it lose another 50%. Here you have 15K, okay, and here you have 20K. So your 70% investment suddenly becomes 35,000. You have nothing to actually cover for that loss. So if you are properly hedged, assuming if all others fall by 50% and this one grow by 100%, then you can sell this one off, and with that 60,000, you can buy the rest of all this on the cheap, instead of using your cash, okay, to keep on averaging down at its go down, okay. So you can actually still retain this cash, but without really needing to use it to buy stocks on the low, because using this gold ETF as a hedge, you can then sell it off and start investing in this. So at some point in time, the gold ETF would actually fall in price. So when it starts to fall in price, okay, you can either exit from here to buy back here, or you use your 30% cash to buy back here. And then when these two start to increase, you exit some of it and you retain back 30% in cash. Okay, so this is how you use something that is an anchor as a hedge against all eventualities. So that's all I have. Okay, Shane, back to you.
Thank you so much, PC, for sharing with us your idea and your view about what is going to happen and what are the fundamental risks, not only in Malaysia, but also in the global stage, and also sharing with us your idea on how we can build our portfolio and how we can manage the risks in the market. All right. So thank you so much, PC, for these sessions.